Hi guys, welcome back to my February portfolio update. Today I'll go over everything that happened in my portfolio in the last month. We'll look at the overall performance, the dividend payments I received and the new stocks that I bought. Last month was actually also the first time in almost a year that I sold out of one of my positions completely. And of course, I will share what this was and why I sold out of it. So grab a coffee, sit back and let's get going. February was a very interesting and eventful month. With the trade tariffs that Trump announced over the last month, especially on Canada and Mexico, but also on China and recently Europe, he is currently doing his best to escalate the building global tensions further. These decisions are raising economic concerns and are adding pressure to the already a bit nervous stock market. This has led to significant volatility in the overall market. And especially the US market did have a hard time with the S&P 500, even having the worst day in the still young year so far. Over the whole month, the S&P was down by minus 0.67% and the Nasdaq 100 even more by almost minus 2%. But at least the MSCI World was still up, although only by a meager 0.4%. But in Europe, the picture was a bit different. Here, we actually had quite a strong start into the year with the Euro stock and the German DAX outperforming the S&P 500 since beginning of the year. The Euro stock 600, for example, could produce 4% returns in February alone. When we take a bit closer look at what drove the S&P 500 in February, the companies that stand out here are the big techs that are in the red the most. We have here Google with minus 12.6%, Microsoft and Amazon with minus 10%, and Tesla even with an insane minus 25% in the red. And as some of the largest position in not only the S&P but also the MSCI World, this has dragged both of these indices down, but because the weight is even higher in the S&P, the effect here was much more pronounced. As you probably know, I am investing globally. But the majority of my investments is still in US companies. So what did this all mean for my performance last month? I started the month with a total portfolio value of 120,628 euros, split between 70,417 euros in ETFs and 93,210 euros in individual stocks. But by the end of the month, my total portfolio worth was 121,636 euros. This is 0.1% higher than what I started the month with. My ETFs are actually down a bit by minus 0.04%, while the stocks are up, also by just a tiny amount with 0.12%. This is only the price return without taking the dividends into account. We'll have a look at how much dividends my portfolio paid me in just a second. But first, I want to show you what I bought last month. And as I mentioned, for the first time in almost a year, I also sold out of one of my positions completely. And of course, I also want to share this with you. But first, the buys. On 21st of February, I bought 7 more stocks of Danaher. And after that, I also bought 59 more shares of Ahold Delhaize on the same day. So in total, I bought stocks worth of 1,980 euros in Ahold, which almost doubles my position with them. So I have already started to act on my plans that I shared with you in my last update. If you haven't watched it yet, my plan for this year is to shift my portfolio a bit away from the US and more towards Europe and Asia. And my reasoning behind this is very simple. It has nothing to do with Trump or the current political environment, but rather with the valuations. Because it probably doesn't surprise you that in general, the US market is valued around 1/4 higher than their 25-year average and on the upper end of their 25-year range. At the same time, Europe is roughly at the average valuation, while Asia and especially China is quite cheap at the moment. This has been going on for a couple of years already, and the valuation gap has widened considerably by now. And remember, I am investing with a long time frame of over 20 years in mind. I don't even buy a company if I don't think that they will be a good investment for at least 5 years. And this statistic shows that over long time periods, it is more lucrative to invest in stocks with a lower valuation. These two graphs here show the 1 and 5 year annualized return for the S&P 500 depending on its valuation. And there is a very clear trend for the subsequent 1 year and even clearer for the subsequent 5-year returns. If a company is higher valued, the expectation on their growth is also much higher. And I believe that the expectation for many US companies is very optimistic right now. We just need to have a look at a stock like Palantir that even after a 30% crash still has a PE ratio of over 200 and a forward PEG of 4. And the PEG ratio even takes the huge growth into account already, but is still more than 4 times higher than the sector median. And yes, Palantir might be quite an extreme example here, but the same is true to a slightly lesser degree for many other companies, also in big tech. Microsoft, for example, that I am invested in and also don't have any plans to sell, is also down by almost 10% since beginning of the year, and still has a forward PEG of 2.5 and a PE ratio of over 30, which is also far from cheap. And please don't get me wrong. Just because I want to shift my allocation a bit away from US stocks, this does not mean that I won't invest in any US companies anymore. I'll just have a closer look at the valuation and will rather use dips to increase my positions that I still want to increase, which you can actually see with my investment in Danaher. Danaher also had a rough couple of months. Since last October, the stock is down by almost 25% and the valuation is now even a bit cheaper than their 5-year average values. But my overall position is still up a bit, and most importantly, I still believe that with their duopoly with Thermo Fisher in the life science, laboratory equipment and bioprocessing market, they are in a great position to benefit from these growing markets over the next decade. And my position in them was also still a bit below my target allocation. So, same as last month, I used the current dip as opportunity to build up my position in them even further. I am actually also planning to make an update video about Danaher soon. So if this is interesting for you, please subscribe to the channel to stay tuned. Earlier in the video, I already mentioned a couple of times that I sold out of one of my positions. This is something that I have actually thought over for the last couple of months now and also briefly discussed in my last portfolio update. The position I sold out of was Rio Tinto. I sold 42 shares also on February 21st with a total worth of 2,593.5 euros. So this sell did finance most of my buys this month, and I actually didn't invest nearly as much fresh money last month than in most other months last year. But this has nothing to do with stocks. If you've been following for a while, you might know that besides the stocks, I'm also heavily invested in real estate. In fact, I own 3 objects in my area, 2 that I rent out and 1 that my family and I live in ourselves. And last month I made a bigger payment towards the mortgages of these objects, which didn't leave as much money to invest in stocks, unfortunately. But back to Rio. I actually bought my Rio position for a total of 2,239 euros in the second quarter in 2023 and sold it now for 2,593 euros right at the last peak. So I actually got pretty lucky with my sell because just a couple of days before that, the position was actually even a bit in the red. But more than half of the total returns are either way coming from the dividend payments that amounted to 208.67 euro. So overall, the company did underperform the market since I bought them, and my investment thesis for them also didn't work out as I first thought. Because my initial bet was on the recovery of the housing market in China that has a large effect on the steel and iron market. And this is by far the biggest business of Rio Tinto. And when I bought into the company, I was also focusing much more on a high dividend yield instead of a high dividend growth. And as also many other mining companies, Rio is paying its dividend based on the operation, which I find generally very good. But it's just not the main focus of my strategy anymore. I will definitely notice this in my yearly dividend payments, as Rio was one of my larger dividend payers. But over the long run, I still think that the focus on high and stable dividend growth makes more sense, especially because I would just reinvest the dividend back into my portfolio either way. And speaking of dividends, of course, I also got a couple of dividend payments last month. JP Morgan kicked off the month by paying me 37.34 euros on 3rd of February. Danaher came next on the day after, even before I could add any more shares, with a payment of €4.68. On the 13th, Texas Instruments paid me almost €48, which was the largest payment this month, while ASML with €10.64 closed the dividend month for me on the 20th. This left the total dividend payments in February at €100.62. And this has brought the total dividends in the first quarter to €184, and thus it has already surpassed the dividend payments I received in the first quarter last year, even though we still have 1 month to go. I am actually very curious where my portfolio and my dividend payments stands by the end of March. When we drill down to the individual performance of my stocks, it seems like the most boring stocks did have the best performance. When we ignore the 2 companies where I bought new stocks, Ahold and Danaher, the best performance last month did have DHL, closely followed by VG. Even Texas Instruments came in at 3rd place last month. The worst performance had TSMC that I just added last month with minus 14% and Microsoft with minus 4.5%. But the dip in TSMC actually suits me quite well, because I just started my position last month, so it is not the full size I would like it to be yet. So I will keep using this dip to further increase my position. When we look at the performance since I started the tracking, Nvidia still has by far the best performance, even though the stock did also come down quite a bit in the last month. They are followed by Meta and JP Morgan, which also have more than doubled already since I bought them. I find this very interesting, especially for JP Morgan, because my intention with this stock is rather to be a safety anchor and dividend payer, not a growth driver. But since October 2023, the stock has appreciated by almost 80% already and vastly outperformed the market last year. And what I find even more interesting is that they did also grow the dividend by 13.6% in 2023. This is almost double the already good growth rate they had in the years before. My other 2 stocks from the financial sector, Visa and S&P Global, did also have quite a good performance recently, with both of them sitting around 40% in the plus. So even though not so many people are talking about these rather boring companies, their performance was pretty good, and I think that they were flying a bit under the radar last year with all the noise about the much more exciting AI and chip stocks. That is not to say that I don't believe that these 3 companies will not benefit from the AI integration. Rather the opposite. It is just not as exciting to talk about these stocks than it is to talk about some of the other more obvious picks like Nvidia, Tesla, Broadcom or even TSMC. Overall, by the end of February, my portfolio allocation looked like this. The sell of Rio has shifted the positions around a little bit, and the size of Ahold as well as Danaher were slightly increased. But most of the pie is actually quite similar as it was last month. But that is not all yet, because we still had earnings season last month and I had several of my companies reporting. Dassault Systems were the first to report on 4th of February, followed by S&P Global on the 11th and Ahold Delhaize as well as TSMC on the 12th. Towards the end of the month, the small cap Surgical Science Sweden reported their numbers by the 19th, VG on the 20th, and Nvidia were the last to report last month on the 26th of February. And there are 2 reports that I want to highlight very briefly. The first is Nvidia. They reported actually quite good numbers and a good outlook, with their revenue being up by 12% quarter on quarter and even 78% on a year-over-year basis. Their full year revenue is even up by 114%. Their outlook is also still pretty good, with the expectation being that the revenue in the next quarter will increase by further 10% to around $43 billion. But the stock did still fall by 8.5% on the day after the earnings. This implies that investors did even expect more than that and were not quite satisfied. I, for my part, am still quite satisfied with their growth and I have no intentions to sell Nvidia anytime soon. But I will also keep a close eye on the ramp up of their new Blackwell chips in the next month. Jensen Huang, at least, is still very bullish on them. During the earnings presentation he said this: "Demand for Blackwell is amazing, as reasoning AI adds another scaling law. Increasing compute for training makes models smarter, and increasing compute for long thinking makes the answer smarter. We've successfully ramped up the massive scale production of Blackwell AI supercomputers, achieving billions of dollars in sales in its first quarter. AI is advancing at light speed as agentic AI and physical AI set the stage for the next wave of AI to revolutionize the largest industries. And if this does not sound bullish to you, then what does? The second earnings that I briefly want to talk about is Surgical Science Sweden. I just bought them earlier last year because their outlook for 2024 was pretty weak and thus the stock was quite cheap. But similar to Danaher, I believe that they have a huge growth ahead of them in the next decade as market leader for medical simulations and control software for medical robots. And while their growth last year was indeed pretty weak, by now the numbers do point upwards again. But what stood out to me in the news report the most are not the numbers per se. It was a new agreement with Intuitive Surgical to ship all DaVinci 5 systems with the simulation from Surgical Science Sweden, and at the same time to switch their revenue model to a subscription-based one. So first of all, I like subscription-based models very much because it just makes the revenue more predictable. And second, I believe that the agreement with Intuitive Surgical will further reinforce their leading position in this market. And because this was not enough, they also agreed to acquire the UK-based ultrasound simulation and training specialist Intelligent Ultrasound, which also expands their business horizontally to ultrasonic simulation applications. With this, I think that they will further establish themselves as the top player in this medical simulation market overall. So a lot has happened in the last couple of weeks. I have actually started to act on my plans for this year by selling out of Rio and by starting to increase my position in Ahold Delhaize. And my plan for the next month is actually just more of the same. I want to further increase my allocation in non-US stocks and especially look for opportunities with stocks that I have on my watch list. Namely, I have Novo Nordisk on my mind and recently also the hidden champion and dividend growth machine Prysmian. And last but not least, I have pulled the trigger on Rio now, but I have not forgotten about the two other stocks that I might sell soon, Texas Instruments and DHL. But I have not finished making up my mind on them yet. Instead, I have actually made a complete analysis on Prysmian just 2 weeks ago, where I said that I find the stock very interesting, but a bit expensive. But during the last 2 weeks since I recorded this video, the stock has crashed by around 20%, which now gives a much more reasonable valuation. So if buying a dividend growth machine at a discount sounds interesting to you, you should check out this video here. That being said, thank you so much for watching guys, and see you in the next video.